Market volatility has returned with a vengeance to start 2022, officially reaching correction territory. Is it time to be concerned about your investments? We tackle that in this week's Fastest 4 Minutes in Finance. Hello once again, I'm Scott Inman. Well, football season is almost over now. A champion has been crowned in the college ranks, and we're just a couple of weeks away from the Super Bowl. Last weekend's divisional playoff round in the NFL was maybe the best ever. It set a record for the smallest total margin of victory for all 4 games. 15 points is all that separated the 8 teams playing, and every game was won on the final play of the game. But not all of those games were close throughout. The Tampa Bay Buccaneers trailed the LA Rams 27-3 in the third quarter. They came back to tie it at 27 before the Rams kicked the field goal on the final play of the game to win it. The Bucs made a great comeback, even though it fell short. Well, we're looking for a great comeback in the stock market these days. The S&P 500 officially reached a correction in intraday trading on Tuesday. A correction is defined as a 10% drop off of a high. If you measure the S&P 500 from the start of the year to Tuesday, it took just 15 trading days to drop 10%. According to LPL Research, that's the 4th fastest drop of 10% or more to start a calendar year ever. So why did it happen? And why did it happen so fast? The first question is easier to answer than the second. We've discussed the economic headwinds in previous Fastest 4 segments. As a review, though, the headlines are inflation, a shift of the Federal Reserve policy toward potentially faster interest rate hikes, and the Omicron wave of the pandemic slowing growth in certain areas. But all of these have been known to investors for a relatively long time. So why the huge sell-off now? Well, the short answer here is it happens. Almost every trading year, there is on average at least one 10% correction. That may be difficult to believe given the lack of volatility in 2021. Our largest pullback on the S&P last year was 5%. It was a pretty smooth ride up. We are also entering a midterm election year, and historically, that means pretty severe corrections. The average max drawdown is 17%. So it's very possible that what's happening is not that unusual, and it is certainly not a reason to panic. But we'd certainly all be comforted if we knew when the market would start coming back up, right? Well, according to LPL Research, the economic data points to that happening. They tell us it's almost a certainty that we will have economic growth in 2022. Corporate earnings will not be as great as last year, but companies will still be posting year-over-year growth, which should be good for stock prices. But just like that NFL playoff game, the measuring stick is not what the score is in the third quarter. The score when the clock expires is all that matters, and your clock matters too. Think about how much time you have until you plan to utilize your assets as income or need to sell them. Maybe you're still in the third quarter. Maybe you're on the opening drive of the game. Or maybe it is getting late in the fourth quarter. Where you are in your game and on your clock should determine how you should react to playing from behind because of market volatility. Thanks for watching.